If you tell anyone living outside of Western society that you earn $100,000 a year and you are struggling to survive, they will literally laugh in your face. To the rest of the world, six figures is the ultimate symbol of wealth. It is the international finish line of financial security, the number that is supposed to buy you a life of absolute comfort, luxury, and freedom. But inside the United States, a terrifying economic shift has occurred over the last few years. Earning $100,000 is no longer the hallmark of the American dream. Instead, it has become a profound psychological trap where you make more money than 90% of the human population, yet you feel completely, utterly poor. You look around your life and realize you aren't wasting money on high-end clubs, you don't own a yacht, and you haven't taken a luxury international vacation in years. Yet, every single month, your bank balance magically resets to a terrifying zero. You have unknowingly become part of a brand new social class sweeping across major cities, the six-figure pauper. In this video, we're not going to talk about generic budgeting or skipping your daily latte, because that outdated financial advice is dead. Instead, we are going to expose the hidden, cold structural engine of the modern American economy that actively drains high earners, analyze the dark psychological phenomenon of wealth cynicism, and hand you the exact high-friction architecture you must build to finally keep the money you sweat for. Let's first dismantle the biggest optical illusion in modern global finance: the deceptive concept of gross income versus what actually hits your account. When an employer hands you a job offer for $100,000, your brain immediately celebrates that total amount, mapping out a lifestyle based on a full 6 figures of buying power. But that number is a complete ghost. The United States tax code is deliberately structured to penalize single, high-earning W-2 corporate employees more than almost any other economic group on the planet. Unlike business owners, you cannot write off your life before paying taxes. The absolute millisecond your company runs its bi-weekly payroll, Uncle Sam steps in to take a massive, non-negotiable bite out of your hard work. First, federal income tax aggressively claims around 15% of your money. Then, FICA automatically strips away another 7.65% for Social Security and Medicare. But here is the real kicker that high earners overlook: state and local municipal taxes. If you are climbing the corporate ladder in major, high-productivity economic hubs like California, New York, Massachusetts, or even emerging tech capitals, state taxes will claw back another 6 to 9% of your earnings. By the time that direct deposit actually flashes on your smartphone checking app, your glorious $100,000 has been automatically gutted by nearly $30,000. Your grand salary is instantly reduced to roughly $70,000 of real-world net take-home pay. That breaks down to exactly $5,833 a month. To a college student or someone living in a low-cost rural area, that still sounds like a massive fortune. But let's look at the brutal geographical reality of what it actually takes to survive as a professional in America today. To earn that high-paying 6-figure salary in your 20s or 30s, you do not have the luxury of living just anywhere. You are forced to relocate to where the high-paying contracts, tech corporate offices, and financial institutions physically exist. And those specific geographic locations charge a massive predatory premium just for the basic right to stand on their soil. This brings us to the crushing weight of the metropolitan housing squeeze. In cities like Austin, Seattle, Boston, San Francisco, Denver, or Miami, a clean, safe one-bedroom apartment within a reasonable commuting distance from the business district easily commands $2,400 a month in rent. If you try to escape the rental trap by buying a median-priced home instead, the modern reality is even more grim. With modern interest rates hovering at historic highs, a standard mortgage, coupled with skyrocketing property taxes and mandatory homeowners insurance, will easily push your monthly housing cost past $3,200. So you choose the supposedly logical, cheaper option. You rent a modest apartment for $2,400. That single mandatory choice instantly deletes 41% of your net monthly income. Your remaining balance is now a lean $3,400. When you pause and look at the calendar, you realize a haunting truth. You are officially working the first 2 weeks of every single month just to pay for the concrete box you sleep in. Now comes the mandatory cost of what I call corporate survival infrastructure. To show up at these high-paying jobs every day and maintain your position in professional society, the system demands a specific level of operational setup. You cannot ride a bicycle 30 miles on a major highway, so you need a reliable vehicle. Because of massive inflation in the automotive sector, the average new car payment in America has climbed to an unbelievable $720 a month. When you add $150 for auto insurance and another $100 for fuel, your basic right to commute to your corporate desk costs you nearly $1,000 every single month. Your usable cash has now shrunk down to $2,400. Next, you have to look at healthcare and the ghost of your education. Even with premium corporate benefits packages, out-of-pocket health insurance deductions, dental plans, and HSA contributions average another $300 a month. And what about that expensive college degree that allowed you to secure the $100,000 job in the first place? The average monthly payment to service federal and private student loan debt for a high earner is roughly $400 just to keep the principal balance from compounding out of control. Let's look at the final, brutal math of your six-figure glory. $5,800 minus rent, minus transportation infrastructure, minus healthcare, and minus your student loans. You are left with exactly $1,700. This is the ultimate illusion exposed. You are making $100,000 on paper, but you are functionally living on a survival stipend of just $425 a week to cover groceries, utilities, phone bills, savings, and an actual human life. When your brain realizes that after working 50 hours a week at a high-stress corporate job, you only have a few $100s of free cash left over, something fascinating and destructive happens to your behavioral psychology. Scientists call this phenomenon wealth cynicism, closely tied to the modern concept of doom spending. In the past generations, people willingly saved their money because a median home cost only 3 times their annual salary. Saving felt purposeful. Today, the average home costs 8 to 10 times the average salary. Your brain looks at the current housing market, runs the math, and says, I will never be able to afford a home anyway, so why am I depriving myself of happiness right now? This deep existential despair triggers a massive behavioral shift. Instead of saving that tiny $1,700 for a distant, impossible-looking future, you subconsciously decide to use it to buy instant, short-term dopamine to cope with the daily burnout of your job. This is the invisible trap of modern micro-luxuries. It is the $45 Uber Eats or DoorDash delivery on a Tuesday night because you are too mentally exhausted to cook and meal prep after a brutal day of corporate meetings. It is the $80 weekend brunch with your colleagues just to vent about your boss. It is the 14 different digital subscriptions silently pulling $15 a month from your account on complete autopilot. None of these expenses look dangerous when they appear on your screen individually. Your brain registers a $12 charge as completely insignificant. But collectively, they form a financial parasite that completely hollows out your remaining cash, leaving you living paycheck to paycheck and totally vulnerable to the very